And this is the recording for chapter 6, financial statement analysis. Very interesting chapter. So stay with me, pay attention, and you can learn some interesting things here. Since we understand how to prepare the financial statements, which are the financial statements, we have income statement, statement of changes of equity, then we have a statement of financial positions, or the other terms called balance sheet. And then we have a cash flow statement, and the last statement is the notes to financial statements. We understand that in order a company to generate income, it has to have a sales. After we did the expenses, we're going to see what kind of income company generated. That income, as long as it stays in the company, is going to be called retained earning, and it's going to move to the equity section on the statement of financial position, statement on the balance sheet. Once it goes as a retained earnings there, it's going to stay there as long as the owners of the company don't decide to declare dividend. Once they declare dividend, that retained earnings is going to move from the company into the hands of the owners as a dividend. So what I want you to understand is the net income increase the retained earnings in the company, and the dividend which the owners take out from the company, reducing the retained earnings in the company. We're going to see this through the statement of owner's equity. In that statement, we can see what is the portion of the common shares, what are the portion of the preferred shares, if there are any. We can see what's the current situation with the retained earnings. Beginning balance, income for the period, dividend for the period, ending balance. After that, we're going to see the balance sheet. On the balance sheet, we're going to see assets, liability, and equity. Remember, everything comes from the basic accounting equation, which assets is equal to liability and equity. We already saw last time that under the assets, we have current assets, which are based on the liquidity, means which one easily be converted in cash, and long-term assets. And for the long-term assets, we have a different assets. We have property, plant, and equipment. We have intangible assets. We have goodwill. Then on the liability, we're never going to cover the liability, but on the liability is the same idea. We're going to have a current liability. We're going to have a long-term liability, and the last thing is the equity section. Today, what I'm going to do is I'm going to show you how to do analysis on the financial statements. On learning objectives, as you can see, a lot of learning objectives this time. To understand and explain the process of financial analysis, identify the common context for financial statements, explain why the knowledge of the business is important when we're analyzing the company financial statements. We have to identify the types of information we're going to use to analyze the financial statements, and how can we find that information. We're going to explain the various perspectives, identify different metrics, identify and calculate, interpret specific ratios, identify and explain the limitation of the ratio, and explain the common use non-international financial reporting financial measures. The most important part of the whole process is you have to understand calculating the ratio. It's important, but the most important part is you to interpret those ratios. Of course, identifying the ratio is one thing, calculating the ratio is second thing, but if I have to put importance on any of those three words, interpret specific ratio, that will be the most important activity that I want you to develop through your study, not only in this course, but the other courses as well. interpretation of what you learn, and interpretation of how you can use whatever you learn. So, how are we going to do financial statement analysis? Well, first we have to figure out what kind of financial statements we have available. Well, we're going to have a statement of financial positions, which is the balance sheet statement. We're going to have this statement of income, which is going to show how much sales we have versus expenses. Again, if there's an income, but if we don't have if the sales are less than the expenses, obviously we're going to have loss. Then we're going to prepare a statement of cash flow to see from where the cash comes in the company. Is it comes from the operating activity? Is it come from investing activity? Is it come from financing activity? Then we're going to have this statement of changes in equity. No, and notes of financial statements going to conclude all the sets of financial reports. Now, the process of analyzing financial statements, we can outline it with a few steps. First, we have to determine for what purpose and in which context we're going to use that analysis. Second, once we know the purpose and the context of the analysis, we're going to collect the information that we need for that purpose. Then we're going to prepare common size. We're going to come to this, what the common size is. And we're going to calculate the ratio. Then we have to do two important activities. First, we have to analyze, and then we interpret those metrics. And once we analyze and interpret whatever we calculated as a ratio, then we're going to prepare conclusion and recommendation. What we're going to do once we know so much about through the ratios. The complexity of the statement of analysis is that each analysis, again, is required for different purposes. If you want to invest, you're going to prepare investment analysis. Who's going to rely on the investment analysis? The one who buying and investing. Commercial lenders, why they're going to do an analysis for what purposes? For just to check what's the credit worthiness of this company. Can they cover their liability? For other purpose can be the customer credit terms. Usually credit department of the company require that customer credit terms. If we're looking for acquisition of the company, we're going to have a different type of analysis. If we have a pension fund and we want to invest in the pension fund, we're going to require different analysis. So how are we going to understand how are we going to prepare the analysis, financial statement analysis? First, see what you know about the business. Let's say you want to invest in particular type of business, in particular industry. Find out what you know about this business. What's the operating activities of that business? What's the risk, currently risks, and economics underlying assumptions of that industry right now? Then, find out what kind of strategy the company using. Are they exceptional company or they focusing on the lowering of cost? Find out what are the key successful factors for that company. Once you have that, then you have to do a little bit more. Lately, part of the financial statement become this annual report and management discussion analysis. So that management discussion analysis is going to help you to understand about the current situation of the company, what are the company needs, what the strengths, weaknesses, opportunity, threats for the companies, and what's the vision and mission of the company. So where they want to go to on the long term. Then you have to review some additional information about the company and the industry. Again, don't focus only on that company that you want to invest itself. Check the whole industry. Check even the current situation in the country that company currently operating in. Read the financial statements. Start with the audit report. Pay close attention to the notes of financial statements. Usually, no one reads the notes of financial statements. Why? Because they're too boring. But that's where you can find the information. Then we're going to the analysis. First one is the perspective analysis. What means perspective analysis? Looking for the future. Try to determine, based on the current situation, based on strengths and opportunity threats of the company, based on the mission and vision, where the company is going to go. Lender might make a forecast of the future cash flow before they give the loan to the company. That's why bank always ask you, can you prepare me pro forma or budget, cash flow statement, budget, cash flow budget. Not cash flow statement, that's incorrect statement, cash flow budget. Now, obviously, there will be challenges with this method because we cannot accurately predict the future. However, knowing better your past, knowing better the history of the company, knowing better on which industry the company works, knowing better what the environment is, you can predict the future. Retrospective analysis is to go to the historical data of the company and to find the trend analysis or the cross-sectional analysis. These methods, again, can be reliable when there are some fundamental changes in the economic environment. So let's say the company working in one industry and suddenly change business from one business to another business. Then it will be hard for us to predict where the company is going to go. The trend analysis versus cross-sectional analysis. Then now let's see what the difference between the trend analysis and the cross-sectional analysis. The trend analysis compares the company results over the period of time. It can start with 3 years up to 10 years. Remember this. If 2 years are given to you, if you have only 2 years, you cannot talk about trend. You can talk about difference between 1 year and another year. For the trend analysis, from statistical point of view, you need at least 3 years. That's the lowest number that you can get. The cross-section analysis, now they compare the results of 2 or more company normal operating in the same industry over the same period of time. So what we're going to do, we're going to get information from the industry about the companies, and we're going to start comparing those companies for the same period of time. But they have to be in the same industry. You cannot compare a company in the IT with the company in the grocery. Those are not comparable. So how are we going to do this? We're going to go directly to the first information on hand, which is the raw financial information. The one, yes? The raw information, where we're going to find it directly from the financial statements. That will be useful for our trend analysis. Since we start talking about this trend analysis, let's talk about something. So the useful for the trend analysis, remember, for the trend analysis, you need at least 3 years. At least. For when you have at least 2 years, then we can compare 1 year with another year, but that's all. We're going to talk about trend. So here on this analysis, we have the raw information of this company, which is given to us. So I'm going to try to extend this one. So we can see the revenue. We can see the operating cost. And we can see how the company goes from 2017 to 2021. We can see the adjusted earning before interest, taxes, depreciation, and amortization. Then we can see how much is the depreciation, amortization, gain on disposal, impairment, inventory, acquisition restriction, financial charges, which will be that interest, financial charges, income taxes, and then we're going to see the net earnings. This is our raw financial information that we're going to use for our preparation of analysis of the financial statements. Then we're going to get some more information. This is from the income statement. As you can see, up to net earnings, we're taking information from the income statement. After that, we have to focus on the next statement, which is the balance sheet. We're going to get the how much is the total assets, how much is the debt on which we pay those financial charges, how much is the shareholders' equity. From the cash flow statement, we're going to get the how much is the cash from the operations, operating activities, and how much we spend to renew our long-term assets. You have to understand this. Always check if you need to invest or you need to analyze the company, is the company actually investing in the future? Means that is the company purchasing long-term assets? Because if they're purchasing long-term assets, they're thinking about the future. Now, we have to come up with some idea how we're going to get the common size analysis. Means, what that means, common size, I'm going to show you very simple. Let me open one Excel spreadsheet and let's work with one Excel spreadsheet. Let's pretend that we have two companies. One company, let's say we try to analyze, let's say Rogers, and they have sales, they have operating expenses, they have actually, let's go here, cost of goods sold, gross margin, operating expenses. That would be more accurate, net income. On the other side, we have exactly the same company, but it's not Rogers. It's a local grocery store. That's a very small grocery store. Nothing scary, nothing fancy, just local grocery store. So sales minus cost of goods sold is going to give you the gross margin, and then we're going to have operating expenses. That's going to give us the net income. That's what we have. So now we have to deal with those two companies. So what we have to do is we have two managers, manager of the Rogers and manager of the grocery store. We're trying to figure out which manager is doing better job. Who is better manager? Sales in Rogers are 15, let's say, $1 billion. Cost of goods sold, let's say $10 billion. That's in billion, right? Cost of gross margin here is $5 billion. Then we have operating expenses, $3 billion. And Rogers generate net income of $2 billion. The local store, they have sales of 100,000 only. It's a local grocery store. You cannot expect too much. 100,000 cost of goods sold are, say, 30,000. So they're generating gross margin of 70,000. Operating expenses 10,000, and they're generating income of 60,000. Which manager doing better job?
The local grocery store,
Why?
because the percentage of his net income is higher compared to that of the Rogers.
Okay, so we're gonna move to percentages analysis, right? So what we're gonna have here, our gross margin here is 5 divided by 15, right? It's equal to 5 divided by 50. Or that will be, as a percentage, 33%. And here, our operating income is gonna be 2 divided by 15, which will be 13%. How about here? We're gonna have 70 divided by 100, and that will be 70%. And operating income is gonna be 60 divided by 100, and that's 60%. And you're right. Looks like the look like the local store, grocery store manager doing better job. So once you move to the percentage, means that you move to the common size financial ratio analysis. Does that make sense?
Yes, sir.
Because obviously numbers we cannot compare it. Compare $15 billion, that's enormous number. 100,000, it's 100,000. This company seems like making ginormous income, $2 billion, but it's only 30% of the sales. Why this company make only $60,000, but that's 60% of the sales. Okay, so understand, when you move to the ratio, that's your common analysis, financial statement analysis. So let's go back to the slides and let's start talking about the common size analysis. Involves converting dollar values into percentage on the specific base amount. Now we have to find what will be the specific base amount. The common size financial statement of income, obviously, all the lines will be converted as a percentage from the total revenue. Let's see how this is going to look like. Again, the revenue always going to be 100%. Earning before taxes, you can see it. Income tax expenses and net earnings. So since we have here 3 years, can we talk about the trend of this company? Obviously we can't. Probably the company is on the, I don't know, it will be hard for me to tell. I need one more year. I need 2022 to see 2022 how they're doing, because they're starting high, they're going down, and then going up again. You guys hear me? Hello? Can you guys hear me?
Yes, you can hear you.
Yes,
I
sir.
can hear you now.
Okay. Okay. I disappeared for a few seconds.
Mhm.
I noticed that I just disappeared for a few seconds. Sorry about that. I'm trying that not to happen again. In the meantime, let me do one small adjustment.